All right. Today is Sunday, the 5th of January, 2025, baby. Happy New Year. I hope everybody coming back home safe and no other passenger took a leak on you with the flight back home. That's the wrong way to achieve gold status. But folks, this is a recap for the stock market activities for the week that was and an outlook for the week to come. And I got a good one for you tonight. This is going to be a really fascinating discussion because by the end of this video, you're going to learn something new. You're going to learn certain levels that you really need to pay attention to, because if we go above these certain levels in certain charts, the game changes. And we're talking even economically, not just market-wise. So this is going to be a combination of talking about both the macro and market dynamics all at once. But let's begin with this, folks, because you're looking at the chart of the SPX, the S&P 500, really simple. So we got a correction of about, let's say, a little over 4.25% top to bottom in the month of December. And then we got a rebound from that decline, almost erasing the entirety of the loss, by the way, because we got a rebound worth about 3.75 percentage point, and that was during the Christmas holiday week. Now, the interesting thing about this rebound, it almost erased the entirety of the loss, but it was so unloved. Nobody really wanted to believe in it. Everybody thought that it's going to be, just the seasonality, the holiday week. Sure, we're going to rebound because of low volume, and then down we go again. This is exactly the approach that we took in this channel. And that was the correct assumption. We went down again, about a little over 3.5%. Then Friday's session, we got a rebound worth about 2%. But interestingly, this rebound is loved. This rebound causing a lot of folks to change their minds if they were anticipating market declines or a correction. Now they're saying, that's not going to happen. And excitement got back into the market that, hey, nothing happened here. We just went down, buy them cheap, higher we go again. Why? Why is this rebound, which is way smaller than the previous rebound, is more loved? To put things into perspective, folks, even though it did not erase the overall bearish pattern in the chart of a topping head and shoulder. So you know what I thought? I thought if we have a bull versus bear discussion, we're going to come up with a really interesting point at the end of it. Let's just brainstorm the bullish versus the bearish case, looking at both market technicals, market dynamics, and the macro. If we begin with the bullish case, we have, it's back, NVIDIA. And this is what we said about NVIDIA in the latest episode. Take a look. Now, NVIDIA looks a lot better than Apple, a lot better than most of the big caps right now. My bullish confirmation is the daily close above the 50 days moving average in blue. My bearish confirmation is daily close below the red line, that's the 100 days moving average. Right now, we have no confirmation either way, but look at the MACD, look at the RSI, look at how it looks as a bull flag. It's a lot better. Maybe inverse and shoulder too, you can play that. It looks a lot better than Apple. So I would use NVIDIA as a hedge. If I'm short SPY, short Apple, short Qs, I'll grab some short-term calls in NVIDIA as a hedge. And here's the update. We have a close above the 50 days moving average, giving us a bullish confirmation. All of the momentum indicators, at least in the daily chart, looking at the MACD, looking at the RSI, are looking really strong. And it closed at the highs of the day. You cannot look at this chart and say that it doesn't look good. It has even an inverse head and shoulder happening in the chart right now. And we know that NVIDIA has a huge weight in the market. If it goes higher, it doesn't matter what happens in the rest of the market. So long as NVIDIA is going higher by, let's say, 2, 3, 4, 5 percentage point, it will take a lot of damage in other corners of the market to take it down. But bear in mind that while the technical pattern looks pretty good, it is a reflection of upcoming expectations about this event, CES 2025. And that's going to happen tomorrow, Monday, 9:30 p.m. Eastern Time. Of course, the anticipation is that NVIDIA is going to announce something new, and that's going to cause a wave of excitement. And this is why the stock is being bought ahead of time. The risk, of course, could be that maybe we're buying the rumor or selling the news if we get no significant news or news that is already priced in. But for now, NVIDIA is certainly in the bullish camp. If it goes higher, it's really hard to knock the market down. On the bearish argument, Apple is the one that's beginning to look weak. So December, Apple was the strong, NVIDIA was the weak. The trade was long Apple, short NVIDIA. Now it appears, at least so far in the month of January, that the trade is long NVIDIA, short Apple. And Apple went down significantly as of late, erasing pretty much the entirety of the rally since the month of December. We do have a really interesting support line where I have my bearish confirmation at 241.81. You close below that for the day, you're probably going to head down to 235, 233. And you look at the momentum indicators, they're turning all bearish. MACD indicator, RSI, and including the Vortex indicator, you see the red line beginning to take over the blue line, indicating a confirmation of the bearish momentum. And all in all, Apple went down by about 7% rapidly. Why do we see, from a fundamental standpoint, why do we see Apple looking weak, at least so far? Well, we know that when Apple has a 5-week streak of 2% plus gains, usually the stock drops the next month by about 5%. We mentioned that before the end of the year. Indeed, we're already down over 5%. And the other thing, of course, is the negative news that we got from Apple that they're slashing iPhone prices and many other products in China because they're losing market share to Huawei. That's a negative, because it has a negative impact on margins. The cost is not going to go down, but you have to sell the product at a lower price because the consumer is not incentivized to buy at the current price. That's usually not a good move. The assumption is it leads to the increase of volume of sales that compensates for the reduction in price, but 9 times out of 10, the strategy doesn't work because it's coming out of desperation. Now, from a technical stance, if we look at the bullish case, it is worth mentioning that the E-mini futures and the S&P 500 is above the 100 days moving average. So if you look at the chart right here, sure, we got a topping head and shoulder too, but the chart is still maintaining support above that red line that you see. That's the 100 days moving average. So support is holding. And for now, until lost, it supports a bullish thesis that we might continue to rebound and at some point recover altogether. Now, in the bearish camp, from a technical standpoint, you got the SPX, the S&P 500, below the 50 days moving average in blue this time around. It's been support before, it's been resistance before, so it is a notable trend line. Now, of course, we've broken above and closed above before during the Christmas holiday week, only to lose it again. So it's not as significant as the 100 or the 200 days moving averages. But it is also important, because if we have a daily close above, it strengthens the bullish case. If we continue to close below, it strengthens the bearish case that we cannot really break above this resistance, and we're going to have to head and make lower lows. When we go to the board again, in the bullish case, the VIX may be supportive because you look at the VIX daily chart, and we can argue, looking at the indicators and the pattern, that this could be sort of a bear flag pattern that leads the VIX back down to the territory of, let's say, 13.5, 15, and a reduction in the VIX leads the algos to buy the stock market, leading it higher. On the bearish camp, bond yields. We cannot ignore bond yields. You look at the 30-year bond yield. I love to look at the 30-year because it is one of the most impactful in the economy. Think about mortgage rates. And also a reflection of the deficit and the bond issuance, the demand by foreign buyers. The 30 usually is a solid indicator. And right now, it appears that if we break above 4.846 basis points, that it becomes inevitable in the weekly chart that we're going to head back and retest the highs from the year 2023. And that was the highest point that bond yields got into since the Fed began hiking rates. So it is significant. It erases all of the assumptions that we had prior, that, yields are going to go down, that inflation is going to go down, that the Fed achieved soft landing, because if that is the case, why are yields coming back up to the highs? The question is, when does the market notices that? More on that in a minute, folks. But we go back to the board. In the bullish case, my favorite indicator is JNK, high-yield junk bonds. If we see JNK heading higher, it is indicative of risk on in the stock market. If we see J&K heading down, but say the market continues to go higher, as we've seen in the month of December, and we pointed that ahead of time as a bad leading indicator, then more likely than not, we see the market pulling back sooner than later. But right now, we see J&K improving, moving higher. It is not reversing this massive bearish engulfing / breakdown candle, but it is right now validating the rebound. On the other hand, looking at the bearish case, we do have the market MACD. We're looking at the monthly for the E-mini futures, the S&P 500, and it's eerily similar to the distribution pattern that we got late 2021 heading into 22 when we got the bear market. You can see the MACD. At some point, we've peaked in the bullish momentum, and momentum changed from green to red, bullish to bearish. And that, of course, was the beginning of the bear market. Are we seeing the same pattern this time around? The answer is could be, because you see the MACD indicator is kind of topping here, flattening out, which is indicative that the bullish wave is coming to an end. It's not confirmed yet, and if we give it some time frame, if it follows the same playbook from 2021, it'll probably in or around the time frame of March of this year, when we change from bullish to bearish. If we go back to the board supporting the bullish thesis, at least in the short run, we still have the Trump optimism. The new president did not take over yet. That is expected at the end of the month, which means that between now and then, we can place some Trump optimism again. That, he's going to deregulate and cut taxes and all of that optimism that we already kind of played out in the fourth quarter of 24. But we can revive some of that. The problem is with the Trump optimism, folks. We talked about how the market played the glass half full in the fourth quarter of last year. But look at this tweet that he did, and it's going to illustrate what I talked about before, that at some point the market will begin to look at the glass half empty side of the Trump presidency. He says the tariffs and tariffs alone created this vast wealth for our country. Then we switch over to income tax. We were never so wealthy as during this period. Tariffs will pay off our debt and make America wealthy again. And of course, he's referring to a chart here, tariffs as a percentage of the revenue for the federal government. And yes, we used to make the majority of the revenue from tariffs, but the world is different now. What I would suggest, looking at this chart for Mark Anderson, pretty please plug in the chart of the Great Depression. And we all know that tariffs were a prelude to the Great Depression. And of course, before that was the crash of 1929. The reality is tariffs was never an economically feasible policy, and especially in today's world. It doesn't make sense at all. It doesn't generate enough revenue to pay for the insane debt and the deficit that we got. It produces inflation, retaliation, and ends up being a bad economic policy. It's a great tool for negotiation. We know that the president loves to negotiate. Now, this is not a judgment about the fair practices of trade by China or Mexico or any other country. You guys know that I'm a critic of NAFTA. But are tariffs the way to remedy all of that? My answer is no, because the negatives outweigh the positives. And I think that if the tariff policy is implemented again, we will see a negative reaction in the market, not a positive one. Now, if we go back to the board on the bearish case, big tech earnings. We're going to roll some of them as soon as this month. What is the problem with big tech earnings? The answer is the law of large numbers. We've exhausted pretty much the majority of the positive catalysts for these names. And now the growth in revenue has already peaked in many of these companies. And we can't really beat the growth in revenue year on year because of the law of large numbers, which makes it pretty much impossible to expand the valuation of these stocks. Furthermore, we continue to see the pattern of these companies spending more while their revenue begins to slow down. And we know why, because they are in an AI war. They have to spend more, but the translation of that spending into an increase in revenue or profits not going to happen for a long time, and that leads to the reduction in margins. The story of the comeback of companies like Meta, Google, Microsoft, the majority of the big cap technology stocks, from the declines of 22, came on the backs of the improvement of margins. Even before the AI catalyst, we have seen stocks like Meta improving. Why? Because they reduced spending. They cut the headcount. The margins were improving again. But if you look at the latest reports and the trends that we see, you look at Meta, for example, in blue revenue growth, it's trending down. On the other hand, you look at the orange column, we have the growth in costs. That's creeping back up. And at some point, you're going to have the same dynamics that led to the decline of the stock back in the year 22. That was, of course, the rate of growth in costs overtaking the rate of growth in revenue. And if you look at this trend, it looks like it's going to happen really, really soon. Another big cap technology giant is NVIDIA. If you look at the trend in the revenue growth, again, it's the law of large numbers. It's pretty much impossible to beat 265% of annual growth, 262. So it's not that the company's revenues are declining, but the rate of growth is. And if the rate of growth is declining, then you cannot really expand the valuation rationally of the underlying stock. Only if NVIDIA can give us a fourth quarter of 24 that reignites the growth year on year, from the latest Q3 24, which was 94%, still impressive, but way less than 265. Say NVIDIA comes out with a rate of growth of over 100% again, sure, then the stock can go higher. But bear in mind, the Q4 24 numbers will be pinned against large numbers from Q4 2023 that led to the expansion of growth by 265%. So it's almost an impossible endeavor. So yeah, we can jerk off to the CES catalyst, or Jensen Huang will do this or announce that. At the end of the day, it comes down, can we resume the growth in the top line in this company or not? You look at Microsoft and the growth in Azure, the revenue engine of the company, that revenue growth also stalled and plateaued. So we see this pattern among all of them, but they're spending more, and this dynamic will lead to deterioration in margins. But let's go back to the board. On the bullish case, we have breadth improvement. A lot of folks say rotation, but let me get you in a secret here. Rotation is just a gimmick word that asset managers use to give the clients the impression that they're actually doing something. They're actually managing something that's worth keeping. In reality, the managers, they're brainless zombies, the majority of them at least, and all what they do is just ride the wave of the Fed manipulation of the market, and everybody looks like a genius. So once in a while, they have to introduce the term rotation to sound smart and they're doing something. But in reality, the market doesn't rotate that much. What happens is we see periods of outperformance and underperformance by different classes of assets. And one of the two ends up catching with the other. If you're looking at the chart right now on the screen, you're going to see that the SPX in orange, that's the S&P 500, that includes the big cap technology stocks. That's performing and looking pretty good right now. But then you look at the RSP, which is the equal weight S&P 500. And then you look at VTV, for example, which is the value ETF, value stocks in blue. You can also plug in the Dow Jones if you'd like. They'll look the same. You can see that there is correlation over the long run. There is positive correlation with the market all in all, the S&P 500. But recently we've seen that divergence of the equal weight and the rest of the market declining big. Matter of fact, it was the worst December performance since 1952, believe it or not. But the only reason you're not seeing it in the stock market chart, the S&P, is because of the outperformance of a handful of big cap technology stocks. Which one is going to catch up with the other? Will earnings from big cap technology companies lead the S&P to catch up with the wreckage that we've seen in the equal weight, value stocks, Dow Jones, the rest of the market really? Or will we see in the bullish case that no, the big tech companies take a breather and we see inflows in buying the dips in the Dow Jones, the value stocks, the dividend paying stocks, the equal weight, the rest of the market that's been ignored in the month of December? In that case, we see RSP, VTV catching up with the move that we've seen so far in the S&P 500. Let me know in the comment section which one you think will catch up with the other. Be interested to hear that. But let me show you something here. If we go back to zoom in a little more to the earlier part of 2024. See, the reason why I say rotations is just a gimmick term, because in the long run, they all move together in the same direction. But there are periods, as I'm highlighting here, where you see, for example, the S&P rallying higher, but we see VTV value and RSP equal weight hitting down. But sooner than later, we see the RSP and VTV catching up with the move in SPX. And if that is the case this time around, it's going to be a net positive for the market. You look at certain stocks, I'm just giving you an example here. In a company called Fastenal, FASD, used to own the name in the portfolio back in the year 23, but we had to sell it because it went way too high too fast, ironically. But this time around, it went down too fast. You look at this decline since the month of November, the stock is down by about 16% rapidly. It closed the gap at about 70.79, which is holding a support right now. The name is really oversold. So if it is the case that we will see value stocks and the rest of the market catching up with the big cap technology stocks, then I see opportunities in buying the dip in these names. But bear in mind, to play the devil's advocate, what if the declines in these kind of stocks, this is an important construction, cyclical kind of indicator to the economy. If it continues to decline without a rebound, what does it say about the health of the economy underneath it all? Something to keep in mind. Perhaps the most important point on the board tonight is the bearish case of the revival of inflation. Because if that happens, then nothing else really matters. The risk of the revival of inflation comes from two fronts: shelter and oil. We have been hearing from the experts, quote unquote, since the year 2022, that shelter inflation is lagging, and you just wait. You will see shelter inflation going down like you've never seen before, and inflation will be defeated, and the Fed already done the job. They should begin cutting rates right now. This was back in 22. Well, it's been over 2 years now, and we still see shelter inflation sticky and actually moving higher. And this is why we see economists being mystified by the rise in CPI shelter. We're not mystified. We know why that's happening, but they are. Now, the truth is, shelter inflation, as you can see in this chart, in red, went down from a high of 8.2 to the reading that we got in October of 4.9. Now, we have a reading in December, and that also came out with shelter inflation going higher. Meanwhile, the CPI went from 9.1 all the way down to 2.6. So why is shelter inflation sticky? And will it go higher again? as the chart suggests. And if that is the case, that's going to lead to a revival in inflation. If we look at the leading indicators to shelter inflation, this is the headline that we got recently. U.S. pending home sales hit 20-month high in November. All of a sudden, we see the housing market heating up again. Why do we see this phenomenon? Because we do have potential buyers. Stock market is still at the highs. We have buyers who still have cash. They can sell and buy homes if they'd like. But they've been waiting for better mortgage rates. And the wait game is becoming a little frustrating because the Federal Reserve, led by Mr. Powell, did cut rates 3 times since September of last year. But the end result is mortgage rates going higher because bond yields on the longer end of the curve, the 10 to the 30, is moving higher. Why is that the case? Well, we've explained that before in details. It's the bond market's way to say that Mr. Powell and the Fed, by cutting rates, you're reigniting the risk of inflation again. And we think sooner than later you're going to end up hiking rates, not cutting them. Now, the interesting phenomenon here, if you're looking at the screen right in front of you, you have in orange the 30-year bond yield. You have in white the chart of crude oil. Do you see a correlation? I do. It's a pretty good correlation. But most recently, we see bond yields heading higher, yet crude oil lagging and not catching up with the move. Who's lying? Who's going to catch up with who? Well, it looks, right now at least, that crude oil is beginning to catch up with the move from bond yields. And if that is the case, then we have an explosive move higher coming in crude oil. What is the significance of that explosive move higher in crude oil? Well, it's going to bring inflation back. Hold your horses, we'll talk about that in a minute. Right now, let's clean up the charts here. What you're seeing right now in candlesticks, still the 30-year bond yield. And what you're seeing in blue, the line chart, is the SPX, the S&P 500, aka the stock market. What I'm pointing at in the chart are points when we've seen the 30-year bond yield breaking previous highs. And that was in the year 2023. Notice that every time that happened, the stock market went down, as I'm highlighting right now. So there is significance that when bond yields make higher highs, we see a response in the market, and that response is negative. Of course, since the peak in the year 23 in bond yields, we've seen a decline. And with that decline came the bottom in the stock market and a rally. But you can notice that we had a period where we've seen both bond yields and the stock market rallying together. What is the significance of that? Because I thought that if bond yields go higher, market goes down. In this case, we haven't really broken significant points yet. It was just a recovery in bond yields under the assumption that now that the Fed is done with hiking rates, the next step would be a pause or rate cuts, and that's going to lead to a revival in the economy. So it is okay for bond yields and the stock market to rally together. But sooner than later, we see this reaction that I'm highlighting right now, where bond yields went higher to a certain level, above a certain level, and the stock market responded negatively. Notice that we can pinpoint that level. We're going to try to do our best here, but it's approximate. It's not set in stone. We can argue that there is significance to the level of 4.7% on the 30-year bond yield. More on that in a minute. But notice what happened after that. Once the yield on the 30-year bond went down below 4.7, the market recovered and moved higher again. There was another period where we see both the market and bond yields going down together. Usually that is indicative of a recession fear. We got one of those during the summer. We got the bad jobs data, which was an anomaly at the end of the day. It was a false alarm. But when they go down together, you know that there is recession fear going on. That's the exception. But then again, we see declines in bond yields. After we notice there was a false alarm with the jobs data, the market recovers again. Then there is a period, once again, of bond yields going higher along with the stock market, under the assumption that the cuts from the Federal Reserve will lead to a revival in the economy. So it's okay for both stocks and bond yields to go higher together because we no longer need the de-risking mechanism of buying bonds. If the economy is going to improve, then you buy stocks, you don't buy bonds. You sell your bonds. So we see bond yields, which has an inverse correlation with the price, going higher along with the stock market. Notice what happened, though, at the area that I'm shading right now, the latest move. Well, we see bond yields going higher again above 4.7 in the market responding negatively. So we know that when the 30-year bond yield trades above 4.7, it's evident we see the market declining. This is really important to keep in mind because if we don't see bond yields heading below 4.7 soon, any rebound is a fugazi. It ain't gonna last. If bond yields continue to head higher from this point, ladies and gentlemen, the market will suffer a correction, no doubt about it. It's gonna be a severe one. Now let's do the same exercise, this time around in candlesticks. Crude oil in blue remains the S&P 500. If we do the same exercise, just look at the patterns. You can do that for your own. You'll notice that there is significance. And again, the number is a little bit low, but I'm just going to pick 80 for simplification. You notice that every time we traded above 80 in crude oil, the market declined. Now there are periods, as I'm highlighting right now, where we see both the stock market and crude oil flushing down together. That's, of course, under recession fears. When we get bad economic data that the unemployment rate is rising higher, when we got certain fears in the economy, sudden fears of government shutdown or whatever, we see both crude oil and the market heading down together. That is the exception. Right now, we see a rally in crude oil, a little bit of a negative response by the market, but we're not at the danger zone yet. We're not at 80 yet to trigger a massive response by the market. But bear in mind, if we look at the chart of crude oil on its own right now, weekly chart, it looks like we have a downward sloping trending line of resistance. And it looks like we're going to break above. If that is the case, usually more than not, it leads to a rally, an explosive rally in oil. That is the case, it will lead to higher yields, and the market will not be able to hold. The other thing you got to keep in mind, notice how the weekly chart of crude oil looks like. Then look at the chart of inflation expectations by the Federal Reserve Bank of Cleveland. It looks eerily similar. As we see inflation expectations going down, we see crude oil heading down. As we see inflation expectations coming back up, we see crude oil heading higher. Chicken or the egg? Inflation expectations leading to crude oil to go higher, or crude oil going higher, leading to higher inflation expectations? I think it's the latter, not the former. Of course, we got a recent manufacturing PMI data where the suppliers are also expecting higher inflation to come and higher prices paid. Not good for the outlook of the economy. It's a huge risk. You look at the weekly performance. This is the first week of the year. We're looking at certain commodities and futures here. Cocoa went up by more than 14% this week alone. Crude oil WTI up about 5%. Heating oil, aka diesel, up a little over 4.5%. Gasoline RBOB, what you paid the gas pump, up a little over 4.25%. Crude oil Brent, up about 4%. You get the picture. If this is sustainable, if we see more where this came from, it will lead to a revival in inflation, and that's not going to be a positive outcome for the market. The other thing I want to show you, you look at, this is from the Bank of Cleveland again, Federal Reserve Bank of Cleveland. The probability that CPI inflation goes above 5% in the next 12 months. In 2024, the expectations were that we have a chance of 22%, that in the next year we will see inflation exceeding 5%. Now in 21, the expectations were about 17.7% chance. So we have higher odds that in the next 12 months we could see CPI exceeding 5% than what was expected in 22 or 21 rather. We actually had CPI exceeding 5% later on. And this is why we're beginning to see Federal Reserve zombies changing their tune. The latest being Federal Reserve Governor Kugler and San Francisco Fed President Daly. Both of them say that the job is not done on taming inflation. Moreover, the president of the Federal Reserve Bank of Richmond, Tom Barkin, says and issues actually a warning of higher U.S. inflation risk after Trump takes power because of the tariffs and the policies by the upcoming administration. Tom Barkin also adds that the Federal Reserve policy may need to stay restrictive for longer due to the inflation risk. Well, it's not restrictive right now, Mr. Richmond President Barkin. Look at risk assets. Look at the mania in the stock market, the meme stocks, the shitcoins. All of that is exactly what happened in 2021, leading to a massive revival in inflation. I don't think the policy is restrictive at all. And that's going to lead to interesting things, to say the least, in the year 2025. Before we wrap it up, let's revisit the morning brief that I fired up before the session on Friday. You can pause this and read it for your own. I produce these morning briefs every day for my Discord members. And we talked about the relationship of NVIDIA versus Apple. That NVIDIA is strong. NVIDIA is the one that's leading the market higher and will lead the market higher. On the other hand, Apple is the week, and we gave you numbers to look for as confirmations for bullishness in NVIDIA and confirmations for bearishness in Apple. We got a bullish confirmation in NVIDIA, no bearish confirmation quite yet in Apple. I also suggested 2 trades, one bearish, one bullish. One for the bearish one is for CMG Chipotle. And I showed you this chart. In the daily, we have the topping and the shoulder. The neckline is about 60.41. We can't really close above. And in the session Friday, we went down fractionally. This could be an opportunity for a correction in CMG because you look at the weekly chart. It is showing lower highs. The momentum indicators are declining. You got the 50 weeks moving average coming up as support next. So this could be an opportunity where we see Chipotle declining, and it could be a bearish trade opportunity. We also have a bullish trade opportunity for Revvion. We talked about this because we got the deliveries numbers. And to begin with, as I suggested here in the weekly chart for RIVN Revvion, it looks as a bullish flag consolidation pattern. Just waiting and waiting to break out to close above the 100 weeks moving average in red. We got the breakout Friday. Here's the result. We closed above. So we got the bullish confirmation. And I suggested that you buy the stock right away. Just buy the stock. At any dip from the open, buy it. And the reason is we're probably going to see a short squeeze happening in this name. Next target would be 1886. So what I did, and this is just for future reference if you're in this situation, and you see a stock breaking out, you'd love to buy shares to chase the momentum. You're waiting for a dip, but maybe the dip is not going to happen. Maybe we'll see stampeding and short covering right away, leading to the chart hitting higher. And then you miss your opportunity of entering. So the best practice here is what I did, which is buying the 15 calls with the same expiration date, 0 DTE, for that Friday. It cost me about $1. We closed at 16.49, so those 15 calls exercised into shares. And even with the entry cost, still got a profit of about 49 cents. Now, what I'm going to do next is selling the 20 calls, covered calls this time around on my shares with the expiration date of June 20th. That's going to net us about, at least right now, the pricing indicates that it's going to be about $2.25 per option or $225 per contract. I think that's going to offer a pretty good value because it raises the break-even price to $18.75, which is in or around the next resistance that I see in the chart. And if Revvion rallies by 30% plus and closes above the 20 calls that I sold, I'm happy to book profits and move on. But bear in mind that this EV/lithium play, I think it's going to be hot for 25. The tariffs is one side of it. I think we're going to be really, really hawkish. The Trump administration, that is, will be really hawkish against lithium originating from China. Furthermore, it's going to be an EV war because China is advancing in EV. They're doing incentives. They're improving self-driving. So we see these themes getting hot. This is why even in the month of November, I was suggesting buying QuantumScape out of a pattern of a falling wedge. And this is the update. You can see that we were kind of playing that breakout. Didn't play out as nice as I expected, but it is playing out. And I think this is going to be a really good theme for 25. We also talked about Lucid in the morning brief dated November 11th. And I showed you this, that even Lucid, which is not the best EV play really, but it's showing the same pattern of a falling wedge. Buy some shares, see how it works out. Here's the result. Huge rally since then. We also added NEO to the Maverick portfolio, so I think these lithium/EV plays will be hot. The exception, of course, the Tesla culties are not going to love this, but you saw this coming, didn't you? I don't like Tesla. I think Tesla is the weakest link. It already rallied, it already priced in any good news. It's only set for disappointment. I mean, the deliveries number was bad, was a decline versus Revvion's increase. You have the political risk. And if just look at the deliveries number alone, wouldn't that lead to a decline in revenue in the report? If that is the case, wasn't the company already facing margin pressures? They can negate the decline in revenues by reducing costs, sure, but that game is limited. You can reduce costs to a certain limit and then you can't do it anymore. You got to improve the top line. And I know what the culties are going to say. They're going to say, oh, but the robo-taxis, Maverick, you don't understand, the rockets, the electric dildos, and all of that. At the end of the day, Tesla has the advantage in data, sure. But who's actually doing progress on the ground right now? It's the company Waymo. And if Tesla's not fast enough to implement the advantage that they have in data, Waymo is going to eat their lunch. And Tesla's going to fall behind. Of course, we're going to do a full analysis here, folks, in an upcoming In Focus segment. We talk about the robo-taxi theme. Of course, we'll discuss the risk on the ride-sharing, Uber and Lyft and all of that. But that is a subject for another discussion. This was a good one, folks. We looked at charts, we looked at dynamics, we looked at a lot of things. So let's just wrap it up right here by visiting the outlook for this upcoming week. What do we have in the economic calendar? We begin Monday, Jan 6, with the services PMI, really important, specifically the price indicator. We have factory orders. Then Tuesday, Jan 7, we hear from Tom Barkin from Richmond again. Then we get data about the trade deficit, ISM services, job openings. Wednesday, Jan 8, the private payrolls from ADP, non-significant in my opinion. Then we have the FOMC December minutes, be interesting, more interesting than the November one. Because here we've already heard Powell and company kind of doubting the path of rate cuts. And there was a dissenter from the Cleveland Fed, so the minutes will be important. Then we wrap it up Wednesday with consumer credit. Comes Thursday, Jan 9th. We have initial jobless claims on top of wholesales inventories. The most important macro day of the week is Friday, Jan 10. We have consumer sentiment. This is a preliminary reading, but it's not the most important piece of data. The most important one would be the employment report. With it, the unemployment rate, hourly wages, you get the picture. This is going to be a market mover because it has an impact on the dollar and bond yields and the expectations of the Federal Reserve rate policy. Now, in the earnings calendar, we have Delta Airlines. It's going to open up the earnings for airliners. They've been hot. Now it's time for validation or die. And with it, of course, an impact to all other airliners that have been rallying really hard as of late. The other thing before I sign out here, folks, if you happen to be a member in Discord, we're going to change the schedule for 25. We're going to have a fixed schedule because, last year I tried to do the different times just to meet folks from different time zones. But it ended up being confusing and it was hard to stick to. So this year, we're going to have a fixed time slot, 7:30 Pacific time in the morning. We're going to do the Top Gun live streams. And then 9:30 Pacific time, we will do the chat for all of Discord members. Give you more updates tomorrow, but for now, folks, this is all I got for you. If you found the video informative, please return the favor by pressing the like button, subscribing to the channel. Please check your subscription because YouTube has been dropping subscribers. They've been dropping members too, by the way. A lot of folks are saying, hey, Maverick, did you stop when you were coming back? Like, I'm already back. I'm putting videos every day, but you're not seeing it because YouTube dropped you. So please subscribe and consider joining us as a member to access all of the features of the channel. All you got to do is just click the join button or follow the links in the description for the Patreon membership. With that, folks, this is all I got for you for now. Thank you for listening. Thank you for watching. Appreciate and love all of you. We'll be talking to you again tomorrow. Good night.
Gets down to what it's all about, doesn't it? Making the wrong move at the right time.
Is that what it's all about?
Like life, I guess. You're good, kid. But as long as I'm around, you're second best. You might as well learn to live with it.